Thank you. Thank you for being here. Before I begin today, I want to tell you something personal. Something I don't talk about often, and I think it's important you hear this before anything else I say. In 1982, I went on national television, Wall Street Week with Louis Rukeyser, the most respected financial program at the time. And I predicted, with complete confidence, that America was headed for a depression. I didn't just believe it, I bet everything on it. I was so certain that I went on record, in newspapers, on television, even testified before Congress. I said the economy would collapse. I was dead wrong. The stock market didn't crash. It began an 18-year bull run, the greatest non-inflationary growth period in American history. And I lost everything. I had to let go of everyone at Bridgewater until it was just me, alone, in a room. I had to borrow $4,000 from my father just to pay my family's bills. We had to sell our second car. I remember looking at my wife and wondering if I had destroyed our future because I was so arrogant, so certain that I was right. That experience changed everything for me. It taught me that no matter how confident I am, I could still be wrong. It taught me humility. It taught me to stress test my thinking, to find the smartest people who disagree with me and listen to them. And most importantly, it taught me to study the mechanics of how the economic machine actually works. Not how I think it works, not how I want it to work, but how it actually operates based on cause and effect relationships that repeat throughout history. So when I tell you today what I'm seeing, understand that I'm not speaking from arrogance. I've had arrogance beaten out of me. I'm speaking from 50 years of studying the patterns, the cycles, and the mechanical relationships that drive economies and markets. And I'm telling you, something is wrong with the machine right now. Something fundamental. And most people don't see it because they're looking at the wrong indicators. It's the second week of January 2026. Most investors feel euphoric. And why wouldn't they? The S&P 500 posted 16% gains in 2025. That's the third consecutive year of double-digit returns. AI stocks are soaring. If you look at your brokerage account, your balance has probably never looked better. You feel wealthy. You feel like your strategy is working. And yet, if you understand how the machine works, you'll see something very different. Let me give you a number that will change how you see everything. The US dollar fell 11% in 2025. That's its worst annual performance since 1973. More than 50 years. Think about what that means. Your 16% gain in stocks, when you adjust for currency depreciation, it's closer to 5% in real purchasing power. Maybe less. But here's what's even more revealing. While you were celebrating stock gains, gold surged more than 60%. Gold outperformed the S&P 500 by 47 percentage points. Let me say that again because it's crucial. The oldest store of value in human history, the asset that central banks hold as their ultimate reserve, outperformed American stocks by 47 points. This isn't random. This isn't noise. This is smart money. Central banks, sovereign wealth funds, institutional investors telling you something important. They are rotating out of American paper assets. They see what's coming. Now, I'm going to explain exactly why this is happening and what it means for you. But first, you need to understand the mechanics. Because if you don't understand why the machine is jamming, you won't understand when it will break or what to do about it. And I'll tell you right now, there's a specific trigger event, actually a confluence of trigger events, happening within the next 90 days that will begin the unwinding of this bubble. I'll explain those triggers in detail later. But first, let me show you the forces that are converging because this is a story about mechanics, not predictions. You see, I released what I call my bubble indicators last week. These are metrics I've developed over 50 years to measure market euphoria. They look at things like new buyer participation, leverage levels, sentiment surveys, price-to-earnings ratios, and the gap between expectations and reality. And right now, the AI boom is registering at 80% of the euphoria levels that preceded both the 1929 crash and the 2000 dot-com bubble. Most people don't understand what that means. They think because AI is real, and it is real, the valuations must be justified. But history shows something different. Every great innovation in history has created a bubble. Railroads were real in the 1850s. The technology transformed America. But investors who bought railroad stocks at the peak lost 80% of their money. The internet was real in 1999. It did change everything. But investors who bought tech stocks at the peak waited 15 years just to break even. The innovation is real, but the price has disconnected from the earnings. That's the definition of a bubble. And we're in one now. The only question is timing. Now, before I explain the historical pattern and what it tells us about timing, I want you to understand something important about my motivation here. I don't want to be right about this, truly. When the bubble deflates, real people get hurt. Retirements get destroyed. Dreams get shattered. I've seen it happen, and it's painful to watch. But the mechanics are the mechanics. And I've learned that if you worry, you don't have to worry. But if you don't worry, you need to worry. That's the paradox of preparation. Let me take you deeper into the machine. I've spent over 50 years studying debt cycles and market patterns, not just the last few decades. I'm talking about the last 500 years of economic history, the Dutch Empire, the British Empire, the rise and fall of reserve currencies, the mechanics of how countries go broke. I've studied them all because the patterns repeat. And there's a principle that shows up every single time, without exception. When debt grows faster than income for a long enough period, eventually something breaks. This isn't politics. This isn't opinion. This is arithmetic. If you borrow more than you can repay, eventually you must either default on the debt, inflate the currency to make the debt easier to pay, or restructure the debt through some kind of painful reorganization. There are no other options. The machine doesn't allow for other options. Let me give you the current numbers because they're staggering. As of January 7, 2026, the U.S. national debt stands at $38.43 trillion. 1 year ago, it was $36.18 trillion. That means the debt grew by $2.25 trillion in a single year. That's $8.03 billion per day, $334 million per hour, $92,912 per second. Think about that. Every second you've been listening to me, the debt has grown by nearly $100,000. By the time I finish this talk, the debt will have grown by millions more. And here's what almost nobody talks about. The interest payments alone on this debt have nearly tripled in 5 years. We're now paying close to $1 trillion per year just in interest. Not principal, just interest. That's more than we spend on defense. That's more than we spend on Medicare. We're paying $1 trillion a year just for the privilege of having borrowed money in the past. Janet Yellen herself, the former Fed chair and Treasury Secretary, warned about this just last week. She said we're approaching what economists call a red line, a debt-to-GDP ratio of 120%. We're there now, the U.S. Debt-to-GDP ratio has crossed 120%, and the consequences are becoming visible in ways most people don't recognize. Now, I need to explain something about debt cycles, because most people only understand the short-term cycle. They understand recessions that last 18 months and recoveries that follow. They understand the Fed cutting rates when the economy slows and raising rates when inflation picks up. That's the short-term debt cycle, and it typically lasts 5 to 8 years. But there's a longer cycle, what I call the long-term debt cycle, that spans 50 to 75 years. It's the cycle of building up leverage across an entire economy, across generations, until the debt burden becomes unsustainable. Here's how it works. In the early stages of the long-term debt cycle, debt is productive. You borrow to invest. The investment creates income. The income pays back the debt with interest, and there's profit left over. Everyone wins. Lenders make money. Borrowers make money. The economy grows. But over time, more and more borrowing goes toward consumption and speculation, rather than productive investment. People borrow to buy things they can't afford. Companies borrow to buy back their own stock. Governments borrow to fund programs they don't want to pay for with taxes. The debt grows, but the income to service it doesn't grow as fast. To keep the borrowing going, interest rates fall. Lower rates make debt more affordable, so people borrow more. But this just increases the total debt burden. Eventually, rates hit zero and can't go lower. That's when you're in the final stage of the long-term debt cycle. And that's exactly where we are now. The only tool left at that point is to print money. Create new currency out of thin air to buy assets, to fund government spending, to keep the whole system from collapsing. And that's exactly what we've been doing since 2008. Quantitative easing, stimulus checks, bailouts. All of it is money printing by another name. But money printing has consequences. It devalues the currency. It inflates asset prices. It creates the illusion of wealth while destroying purchasing power. And eventually it causes people to lose faith in the currency itself. You know, every time this happens, and it's happened dozens of times throughout history, people say the same 4 words. This time is different. They said it in 1929 before the crash. They said it in 2000 before the dot-com bubble burst. They said it in 2008 before the housing collapse. They always find reasons why the old rules don't apply anymore. New technology, new monetary tools, new economic paradigms. It's never different. The names change, the technologies change, the specific triggers change, but human nature stays exactly the same. Greed and fear drive the same behaviors century after century. People chase returns during the boom. They panic during the bust. They always believe they're smarter than history. And right now, I hear the same arguments I heard in 2000, but the technology is real this time. AI will change everything. Productivity will soar. Earnings will catch up to valuations. And I agree with part of that. AI is real. It will change many things. But that doesn't mean the current valuations are justified. Innovation and valuation are 2 completely different things. You can have a real technology that transforms the world and still lose 80% of your money if you buy it at the wrong price. That's what happened with railroads. That's what happened with the internet. And that's what's going to happen with AI for investors who don't understand the difference. Now, there's something happening right now, in January 2026, that I believe will be the catalyst for the transition. It involves the Federal Reserve, the earnings expectations for the fourth quarter, and a policy shift that most people aren't paying attention to. I'll explain exactly what that trigger is soon. But first, I need to show you the illusion that's keeping people trapped in this bubble. I call it the money illusion. Here's something most investors don't understand, and it's costing them their future wealth. When you look at your portfolio and see a 16% gain, your brain registers that you're richer. But are you? What if the currency those gains are measured in lost 11% of its value? What if the things you need to buy, food, housing, healthcare, education, went up by 3 or 4%? What if gold, the oldest and most reliable measure of real value, went up 60% while your stocks went up 16%? When you do the math honestly, your 16% gain becomes something much smaller. In real terms, in terms of what you can actually buy with your money, many American investors lost ground in 2025 while celebrating what they thought were gains. This is the money illusion. The numbers on your screen go up, but your purchasing power goes down. And because inflation compounds over time, this erosion accelerates until one day you wake up and realize your wealth can't buy what it used to. You're nominally richer but actually poorer, and you didn't even notice it happening because you were watching the wrong numbers. But here's what's really important, and this is what I mean by a paradigm shift. For the past 15 years, the dominant investment strategy was simple. Buy American stocks, especially technology, and hold forever. The dollar was strong. U.S. assets outperformed the world. This created a self-reinforcing cycle, where more money flowed into U.S. assets, which pushed prices higher, which attracted more money, which pushed prices higher still. That paradigm is ending. Look at the data from 2025. Gold, up more than 60%. Emerging markets, up 33%, double the S&P return. European stocks outperformed the United States. The UK FTSE 100 outperformed major global markets. The U.S. S&P 500 up 16%, but measured in a currency that fell 11%. Do you see what's happening? Smart money is rotating out of U.S. assets. The trend that defined the last 15 years is reversing. And most American investors don't see it because they're still looking at nominal returns instead of real returns. Foreign investors hold over $30 trillion in American stocks and bonds. $30 trillion. And they're starting to hedge their currency exposure, which means they're selling dollars. This creates downward pressure on the currency, which makes their U.S. holdings worth less in their home currency, which causes more hedging, which causes more dollar selling. This is the feedback loop that's already begun, and once these loops start, they tend to continue until they reach an extreme. Let me explain why the dollar fell 11% in 2025, its worst performance since 1973. There are three forces driving this decline. First, the debt dynamics. When you owe $38 trillion and you're adding $8 billion more every single day, investors around the world start asking a simple question. How will this ever be repaid? And there's really only one realistic answer: inflation. Print money to pay the debt. Devalue the currency so the debt becomes easier to service in nominal terms. And when markets expect that kind of inflation, they sell the currency in advance. Second, policy uncertainty. President Trump has made clear he wants lower interest rates, much lower than current levels. He's publicly stated that anyone who disagrees with cutting rates will never be Fed chairman. This threatens the Federal Reserve's independence, which has been the foundation of dollar credibility for more than 50 years. When the world's largest economy appears to be subordinating its central bank to political pressure, investors lose confidence in the currency. Third, capital rotation. European investors alone hold $8 trillion in U.S. assets. Much of this exposure was unhedged, meaning they were making an implicit bet that the dollar would stay strong. Now they're starting to hedge. And every hedge transaction involves selling dollars. At $8 trillion in European holdings alone, even a small percentage shift in hedging behavior moves markets significantly. This is the mechanics of why the dollar is falling. And it's why I've been saying for over a year that cash is trash in this environment. Holding dollars is not safety. It's a slow-motion loss of purchasing power. Now, here's something that will make this political. And when things become political, they become unpredictable and dangerous. The top 10% of Americans own the vast majority of stocks. They've seen their wealth compound for 15 years. For them, inflation is an inconvenience, not a crisis. They can absorb higher prices without changing their lifestyle. But for the bottom 60%, the people who don't own significant stock portfolios, who live paycheck to paycheck, who rent instead of own, inflation is devastating. Their wages haven't kept up. Their savings have been eroded, and they feel it every single time they buy groceries or pay rent or fill up their gas tank. I believe the purchasing power of money will become the #1 political issue of 2026, and when that happens, the pressure on policymakers to do something will become irresistible. That something is usually more money printing, more stimulus, more short-term fixes that make the long-term problem worse. This is the trap we're in. There's no easy way out. Every solution creates new problems. So the question becomes, when does the music stop? When does the bubble begin to deflate? I said there's a specific confluence of trigger events happening within the next 90 days. Let me now explain exactly what those triggers are. Here's what I see converging right now. Trigger number 1, the Federal Reserve leadership transition. Jerome Powell's term as Fed chair expires in May 2026. President Trump is expected to announce his replacement within the next few weeks. He's narrowed it to a short list that reportedly includes Kevin Hassett and Kevin Warsh, both of whom are expected to be more aggressive about cutting interest rates. But here's the complication that most people aren't following. There's now a Department of Justice investigation into Powell. Republican Senator Tom Tillis has publicly stated he will block any Trump Fed nominees until this legal matter is resolved. And the Supreme Court is actively considering whether the president can remove Fed governors at will. This creates enormous uncertainty about who will control monetary policy and whether the Fed can remain independent from political pressure. Markets hate uncertainty, and this uncertainty is happening at the worst possible time, when the economy is showing signs of stress and the bubble is at its most inflated. Trigger number 2, impossible earnings expectations. We're entering fourth quarter 2025 earnings season right now. The expectations are priced for perfection. AI companies need to demonstrate that their massive capital expenditures are translating into actual revenue and profit. Not future revenue, not projected profit. Actual results. If they disappoint, even slightly, the repricing will be brutal. Remember, stocks are priced based on expectations of future earnings. When expectations are this elevated, there's no room for disappointment. Even meeting expectations might not be enough. The market might need beats, and significant beats, just to maintain current prices. And the macro data is pointing toward disappointment, not beats. Trigger number 3, JP Morgan's recession probability. J.P. Morgan Global Research has assigned a 35% probability to a U.S. and global recession in 2026. That's a 1 in 3 chance. This is not a fringe prediction from a permabeer. This is one of the largest and most respected financial institutions in the world saying there's a 1 in 3 chance of recession. This contradicts the soft landing narrative that's currently priced into stocks. Markets are priced for continued growth, continued earnings expansion, continued prosperity. If recession risk is actually 35% while stock valuations are at bubble levels, something has to give. Trigger number 4, the debt ceiling and fiscal chaos. The government just emerged from the longest shutdown in U.S.N. history. 43 days. Spending authority continued through a continuing resolution until January 30th. The debt limit was raised by $4 trillion in the One Big Beautiful Bill, which adds even more to future deficits. When you have $38 trillion in debt, $1 trillion in annual interest payments, and no credible plan for fiscal sustainability, eventually the bond market revolts. We're not at that point yet, but the conditions are building. Every auction, every treasury sale, is a test of whether investors still have confidence in U.S. debt. So far the tests have been passed, but the margin of safety is shrinking. Now here's the trap the Federal Reserve is in, and this is crucial to understand. If they cut rates aggressively, as the president wants, they risk reigniting inflation that hasn't been fully tamed. The dollar falls further. Asset bubbles inflate more. The eventual correction becomes even more severe. If they hold rates steady, or raise them to fight inflation, they risk triggering the recession that JP Morgan is warning about. Stock prices fall. The wealth effect reverses. Consumer spending drops. Unemployment rises. There's no good option. This is the consequence of 15 years of easy money, of kicking the can down the road, of solving every problem with more debt and more money printing. The problems were pushed forward, and now the chickens are coming home to roost. I call this the beautiful deleveraging problem. A beautiful deleveraging is when you reduce debt burdens gradually, without triggering either depression or hyperinflation. It's possible. It was done in the 1930s and 1940s after the Great Depression. But it requires political will, shared sacrifice, and coordinated policy that I simply don't see in today's environment. Instead, I expect more of the same. Printing money, supporting markets, devaluing the currency, pushing the real problems further into the future, until you can't push them anymore. Now, I want to be clear about timing, because this is where most predictions go wrong. I'm not predicting a crash tomorrow. That's not how these things typically work. Bubbles don't pop in a single day. They deflate over time. The process is gradual at first. volume declines, enthusiasm fades, prices plateau instead of rising. And then, slowly, the narrative changes. People who were bullish become cautious. Caution becomes concern. Concern becomes fear. And fear, eventually, becomes panic. This process typically takes 12 to 24 months from the peak of euphoria to the bottom of despair. We're at 80% of the euphoria that preceded 1929 and 2000. That suggests we're close to the peak, but not necessarily at it yet. The trigger events I described could accelerate the timeline. Or the Fed could print more money and extend the bubble further. That's possible too. They've done it before. But extending the bubble just makes the eventual correction more severe. The longer the imbalances build, the more painful the resolution. Either way, the direction is clear. The destination is certain. The question is only the timing and the path. So what should you actually do with this information? I promised I'd tell you what I'm doing personally, and I will. But first, I want to explain a principle that's guided me since my 1982 mistake. I call it the Holy Grail of investing. The Holy Grail is diversification done right, not the fake diversification of owning 10 different technology stocks. That's concentration disguised as diversification. Real diversification means owning assets that are uncorrelated, assets that move independently of each other, based on different drivers. Here's the key insight. You can dramatically reduce your risk without reducing your expected return if you find 15 to 20 uncorrelated return streams. The math is almost magical. Properly diversified portfolios can achieve the same return with far less volatility, or higher returns with the same volatility. This is why I developed what I call the all-weather portfolio. It's a portfolio designed to perform reasonably well in any economic environment, whether it's inflationary growth, deflationary recession, stagflation, or anything in between. You don't need to predict which environment is coming. You need to be prepared for all of them. That's the Holy Grail. So let me share what I believe makes sense in this environment. And I want to be clear, I'm not your financial advisor. I don't know your personal situation, but I can tell you what principles are guiding my own thinking. Step 1. Reduce your U.S. equity overweight. If you're a typical American investor, you're probably dramatically overweight U.S. stocks, especially technology. This was the right position for the last 15 years. It may not be the right position for the next 15. The data shows capital rotating out of U.S. assets and into international markets. Gold outperformed stocks by 47 percentage points in 2025. Emerging markets doubled the S&P return. This isn't noise. This is a signal. I'm not saying sell everything and run for the hills. I'm saying rebalance. Take profits from the winners that have made you money. Reduce your concentration risk. Don't let one bet, no matter how successful it's been, dominate your entire financial future. Step 2. Own what central banks are buying. Central banks around the world have been accumulating gold for months. China, Russia, India, Turkey, they're all adding to their gold reserves. They're diversifying away from dollar assets. This is institutional behavior at massive scale, not retail speculation. Gold isn't just a shiny metal. It's the only currency that isn't someone else's liability. When governments print money to pay their debts, gold maintains its purchasing power over time. That's why it outperformed so dramatically last year. And that's why it may continue to outperform as the debt dynamics play out. Step 3. Diversify internationally, non-U.S. Stocks outperformed U.S. stocks in 2025. Europe, UK, China, emerging markets all did better than America when measured properly. This is the paradigm shift I've been describing. Capital is no longer gravitationally bound to the United States. For American investors, this is psychologically uncomfortable. We've been trained for years to believe U.S. assets are always the best choice, but the data says otherwise. And following the data, rather than our biases and our comfort zones, is how we avoid catastrophic mistakes. Step 4. Maintain some liquidity. Cash is trash in an inflationary environment, I've said that clearly. But having some liquidity, short-term treasuries, money market funds gives you optionality. When the bubble deflates, and it will deflate, there will be extraordinary opportunities to buy quality assets at discounted prices. But only if you have liquidity available. The worst position in a correction is being fully invested in overpriced assets with no cash reserves. You'll have no choice but to sell at the worst possible time. Liquidity prevents that trap. It gives you staying power. Step 5. Think in purchasing power, not nominal returns. This is the mindset shift that matters most. Stop measuring your success by the number on your brokerage statement. Start measuring by what that number can actually buy in the real world. A 16% return in a currency that fell 11% is not a 16% return. It's closer to 5%. And if inflation was 3% on top of that, your real return was 2%, maybe less. That's the truth that the money illusion hides from you. When you start thinking in purchasing power terms, you'll make different decisions. Better decisions. Decisions that actually protect your real wealth instead of just your nominal wealth. I want to leave you with something I've learned over 50 years of studying these cycles. Evolution is the only constant. The species that survive aren't the strongest or the smartest. They're the most adaptable. The same principle applies to investors. The paradigm that made you money for 15 years may not be the paradigm that makes you money for the next 15. And the people who can't adapt, who keep fighting the last war, who assume the future will look like the past, they're the ones who get hurt the most. Pain plus reflection equals progress. The pain of my 1982 mistake taught me more than all my successes combined. If you experience pain in the coming transition, and some of you will, use it. Reflect on what went wrong, extract the principle, write it down, and come back stronger and wiser. The machine operates on rules that don't change. Human nature doesn't change. The mechanics of debt and credit don't change. Understand the rules, and you can navigate any environment. Comment below and tell me what you're seeing in your local economy. Are prices rising faster than your income? Your observations matter. Remember, if you worry, you don't have to worry. But if you don't worry, you need to worry. Thank you.